Welcome to our audit series. In this series, we're breaking down the entire audit process step by step to make it practical and useful for auditors in public accounting. Before an audit even begins, there's one critical step that sets the foundation for everything: initial communication and the engagement letter. Get this part wrong and your audit can be in trouble before you even touch a single account. In this video, I'm going to walk you through exactly what happens in the early stages of an audit, covering how auditors communicate with the client, key independence issues to consider before accepting an engagement, a detailed breakdown of the engagement letter, and a downloadable engagement letter template for you to follow along. If you're in public accounting or just learning about audit, this is the foundation of everything. Step 1, initial communication with the client. The first step in any audit is reaching out to the client. This is where the audit team starts gathering information, setting expectations, and identifying any risks before fieldwork begins. So, what should be covered in these discussions? Let's go through some of the key points. Scope of the audit. What period is being audited? Are there any significant changes from prior years? Why does the client even require an audit? Is the company publicly traded? Does the company have a loan with a bank that has a debt covenants that requires the company to have audited financial statements? Key deadlines. When does fieldwork start? When does a client need to provide audited financial statements? Prior year issues. Were there any significant findings last year? Was the company even audited in the prior year? Regulatory or business changes? Any acquisitions, mergers, or large transactions that can impact the audit? These discussions typically happen between the partner, the audit manager, and the CFO, controller, or the client's accounting team. If you're a staff auditor or associate, you won't be leading these discussions, but you need to understand how this information impacts the audit plan. Whether it's an email summary or notes in the audit file, miscommunication and lack of audit documentation is one of the biggest risks in an audit. Step 2, independence check. Now, before we can even sign an engagement letter, there's a critical question we need to answer. Are we independent? Independence is the backbone of audit credibility. If auditors aren't independent, the audit opinion is literally worthless. Here's what we can check before accepting an engagement. Financial interests. Does anyone on the audit team own stock in the company or have a financial stake? Past relationships. Has anyone on the audit team worked for this client in the past? If so, were they involved in a financial reporting role? Providing non-audit services. Are we doing bookkeeping, tax work, or any other service that might impair independence? Family relationships. Does any member of the engagement team have a spouse, sibling, or close relative in key management at the client? If there is an independence issue, we either need to remove the conflict or decline the engagement. Independence issues can get audit firms into serious trouble with regulators. Always perform an independence check before proceeding. Step 3, the engagement letter. Now let's talk about the most important document in the audit, the engagement letter. This is the contract that defines the relationship between the audit firm and the client. I have provided a downloadable engagement letter template in the description. Pull that up and follow along. All right, we're now going to go through an actual engagement letter, and then obviously from when you're actually in the field and you're going to be going through your own audits, your engagement letters could look slightly different, or they probably will be a lot more robust. But if you can understand the key aspects of the engagement letter, they're all going to be exactly the same. Again, where they have more legal language, yes. Are they going to be like much more lengthy than this one that I put together? Yeah, of course it is. But if you can understand the key aspects of this engagement letter while we kind of go through it live on this video, then you'll get a good gist of what an engagement letter is, the key aspects of it, and just being able to talk about, the key aspects of an engagement letter on your audit. So we'll start off with just kind of the first paragraph. So the first paragraph we'll kind of read along. It says here, let me make this a little bigger here. So it says, this letter confirms our understanding of the terms of our engagement to audit the financial statements of, obviously, client name. We'd say, in our case, CPA swag, right? So if you want to fill that out, let's fill it out. And then that'd probably be a good practice for you guys also to be able to fill out these engagement letters. CPA swag LLC. That's going to be our company, right? That's the company that's kind of our example company in all our audit videos. So we're going to say CPA swag, and we're going to say that dear client name, dear CPA swag LLC, or we can say, dear, you know what? Let's address this to dear Bryan. Or, yeah, because typically you would address this to like the actual, the CFO or the controller or even the CEO of the company. Dear Bryan, let's just say Dear Bryan for now, or Dear Bryan Carreto. All right, that's going to be, yes, that is me. All right, so Dear Bryan Carreto, this letter confirms our understanding of the terms of our engagement to audit the financial statements of CPA Swag. That's the company, right? For the year ended, now we're going to say, okay, well, what year are we even auditing? So in our example, it's 2024. It's February 2025, but we're going to audit the previous year, right? The previous fiscal year. And their fiscal year ends on December 31st for our example. So we're going to put December 31st for the year end, December 31st, 2024. That's going to be for the full year. Their fiscal year, again, ends on 12/31/2024. So that's going to cover 12 months prior to that. So then this engagement will be conducted in accordance with generally accepted auditing standards, GAS. Okay, that's going to be the auditing standards in which we're going to perform this. And we will include examining on a test basis, right? Because remember, audits we don't provide absolute assurance, right? We provide reasonable assurance because an audit is done on a test basis. Every single account, we get comfortable with it by testing a certain sample of each population of each account, right? So evidence, and we'll get to that through this audit series. We'll continue to do that, and hopefully you guys can kind of start learning how to test different accounts, sampling, all that good stuff. We're going to cover everything. Evidence supporting the amounts and disclosures in the financial statements. The objective of our audit is to express an opinion on whether the financial statements present fairly in all material aspects. The financial position of client name is CPA Swag. CPA Swag, LLC. And then one thing you'll usually see in a lot of engagement letters too, and this is kind of like you have to, and then one thing you need to start learning, especially when you're writing in these legal documents, is that whenever you have a company name, you can then define it as the company, right? So anytime you say the company after this initial line here, you're defining it right here. You're saying CPA Swag is parentheses the company. So anytime you say the company thereafter, it's gonna the reader of the legal document is gonna know that you're talking about CPA Swag. So in here we can say the financial position of the company. But remember, you have to define it. The first time you name something, you can then define it. And this is defining, hey, I'm calling CPA Swag is the company. So anytime thereafter in this document, I say the company, I'm referring to CPA Swag. So in here we can say the company in accordance with applicable financial reporting framework. We are in the U.S. We're in the great United States of America. So we're going to say generally accepted, should be generally accepted accounting principles. In accordance with GAAP, generally accepted accounting principles. Cool, awesome. So that's going to be our financial reporting framework. Oh, I hit F7, sorry. So then, perfect. All right, now let's go through, number one, the objective and scope of the audit. So the audit will be conducted to obtain reasonable assurance. Again, that word, reasonable assurance, right? We're not, when you do an audit and we test a certain amount of each material account to get comfortable with the entire account. But again, we're doing everything on a sample and test basis. It's going to be rare that some accounts you may test 100% of it, but like I don't know, debt, you might send a confirmation. But at the same time, yeah, okay, sure. But again, I don't want to get lost in the sauce, but just remember, reasonable assurance. We do everything on a test sample basis in an audit. When we actually get to the actual testing, you guys will see what I'm talking about. The audit will be conducted to obtain reasonable assurance that the financial statements are free from material misstatement, whether due to fraud or error. This includes reviewing financial records and transactions. Obviously, we will do that. Performing substantive and analytical procedures. I can't wait to start doing analytics with you guys because you'll understand in analytical procedures, you're essentially saying, hey, the account changed this amount year over year. Is that reasonable based upon what happened in the business? Did we get, like, let's just say, for example, the company had a 10% increase in revenue. You wouldn't just ask your client, hey, why'd you increase revenue? Because I've been asked that as a controller, and it's like, oh, dude, we sold more stuff. No, you want to know, like, hey, do you have a new product line? Did you hire a new sales team? Therefore, they're producing more sales. You want to, as an auditor, you want to get as as nitty gritty as you can while still being efficient and obviously getting comfortable with the account balance. But substantive analytical procedures are another form of testing that you can do instead of sampling. We'll get more into the details of how and when you can only perform an analytical procedure in lieu of doing actual sample testing. But that's going to a little bit more granular, and we'll get into that, into audit methodology and theory and how to actually perform testing over accounts. But just remember, substantive analytical procedures are typically like in the word it says, it's an analytic. You look at the change in an account balance year over year, or you benchmark it off some other period, comparing it to your current period, and you get comfortable with how the balance changed year over year, month over month, or whatever period you're auditing. Okay, and then next, assessing internal control effectiveness where necessary. This is gonna depend also too. Obviously, you want to get comfortable with their internal controls, but unless it's like a large accelerated filer or a public company, typically you wouldn't issue an opinion on internal controls. But we still want to get comfortable that there's no material weaknesses in their internal control process, because then that could lead to material misstatements in the financial statements. And then next, reporting on any material misstatements or financial reporting issues. Yes, so that's the objective and scope of the audit. It's essentially to get management's financials and assess and give an opinion on whether those financial statements are materially correct. That's pretty much it. But again, that's going to include all of these procedures that we laid down here. Next, we're going to go over management's responsibilities. One thing you need to keep in mind when you're doing an audit, although you're auditing the financial statements, they are management's financials. Don't forget that. Remember, although we are the auditors and we're issuing an opinion on these financials, they are not our financial statements. It's management's. Management is, at the end of the day, management is responsible for the preparation of these financial statements. So management's responsible. So management is responsible for preparing and presenting the financial statements in accordance with GAAP, IFRS, or other framework. We are going to say, and then you know what? Let's up here, since we're going to say GAAP down here, remember from our earlier example, we have to define it first. Now that we did, now anytime we say GAAP, going forward, now everyone's going to know it's going to be generally accepted accounting principles. Perfect. So then we say, okay, and responsible in accordance with GAAP. So again, we are in the United States, or even if you were some other part of the world and you're going to prepare financial statements under US GAAP, you can do that. I've seen that happen before. All right. So we're going to say that, remember, again, I want you to keep this in mind. Remember, always remember for the entirety of your career, management is responsible for the preparation and presenting the financial statements in accordance with GAAP. We are the auditors. We're issuing an opinion on these financials. They are not our financial statements. Next, designing, implementing, and maintaining effective internal controls to prevent and detect fraud. Again, that's management's responsibility. That is not the auditors. Next, providing unnecessary records, documentation, and explanations to support transactions, complying with laws and regulations applicable to the company's operations, and confirming oral representations in written management representation letter. This is probably one of the most important things that management does for us at the conclusion of an audit. So at the conclusion of an audit, the auditor will say, hey, I had these findings, I had these things. Maybe you had adjustments, maybe you didn't. Maybe you had past adjustments, which I will get to again at some later point because it's a whole separate topic. But management, at the end of the day, they have to rep to the fact that we give them a management representation letter and they say, yes, I'm fully aware and I agree that I gave you X amount. I gave you full information on my accounts receivable. I gave you all the contracts that I know of. I gave you all the leasing contracts that I know of, that I'm aware of. I have no fraud that happened this year that no fraud happened, or if any fraud did happen, I told you all about it, or certain things like that. The auditor kind of tries to protect himself in a way to say, hey, look, based on all this information, and I can only know as much as you give me, management is essentially saying they are representing and writing a written letter to the auditor saying, I gave you XYZ. And again, the auditor is going to prepare that and he's going to ask management to represent to the fact of various different things that occurred during the audit. Okay, now auditor's responsibility. So obviously, just because management is responsible for the financial statements doesn't preclude the auditors from having some responsibility. Of course it does. Again, this letter kind of lays that out. So as auditors, we will conduct the audit in accordance with GAAS, generally accepted auditing standards. So you know what? And it's not defined. Oh, it is defined. Look, see that? So once it's defined, now we can say the abbreviated portion of it. Conduct the audit in accordance with GAS, yes. Provide reasonable assurance, but not absolute. Again, provide reasonable assurance, but not absolute assurance that the financial statements are free of material misstatement. Beautiful. Evaluate the appropriateness of accounting policies used and reasonableness of significant estimates. Yes, that's our job. Again, management's job is a preparation of this, right? Going back up here, preparation and presenting the financial statements in accordance with GAAP. But we also, as auditors, we need to assess and provide assurance that the financial statements are free of material misstatement. That's our job. Again, our job isn't to find every single dollar error. Our job is to find errors that make the financial statements free from material misstatement that wouldn't mislead a user of a financial statement, an investor, a bank, someone that's going to use these financials that we're going to issue to the public. It wouldn't mislead them or misguide them to make a material decision, investment decision, whatever kind of decision it is, based on this information that we're going to give them, which is, again, our opinion on top of the financial statement saying, hey, this financial that's going out to the public, we're okay with it. I mean, we're all right with it. For the most part, it's free of material misstatement. You can generally rely on this financial being free from material error. It should be accurate. That's essentially what we're saying. Again, it's very layman's terms of how I just said that, but that's essentially what it is. Okay, next thing, evaluate the appropriateness of accounting policies used in reasonable significant estimates. Yes, we'll get into significant estimates later, but significant estimates could be your allowance for credit losses or AR reserve before ASC 326 came out, your inventory reserve, things of that nature that are estimates in nature that management has to make an estimate or a provision against a certain account balance. And communicate significant audit findings to management and governments. Yes, that's also a responsibility of the auditor. As auditors, we're going to audit the financials, but at the same time, we also need to let management make them aware of any audit findings we have, any adjustments that we may present, or any other findings in internal control that we think that management should be aware of. Next is audit limitations. Of course, like I said earlier, there's going to be audit limitations because we're not testing 100% of each account balance. We're doing everything on a sample basis. So we need to outline that in this engagement letter. We're going to say our audit will be conducted on a test basis, meaning that not all transactions and balances will be examined 100%. We don't test. You can test 100% of each account balance, but I guarantee your audit's probably going to take you forever, if not the whole year, if not 2 years, to do 1 year audit, and that's just not. It's not reasonable to do that. You can do that, but again, like I said, it's not a reasonable approach. That's why there obviously are limitations to an audit. We are hopefully there to catch any material misstatements, but again, to catch all of them, it's just inherently impossible because of the limitations that we have. But when we do our audit sampling, you would hope that your sample is representative of the population, so therefore we can rely on it. So accordingly, there is a risk that material misstatements, including those caused by fraud, may not be detected. Yeah, there's a chance that that could happen. The audit is not designed to provide absolute assurance, 100%. All right, deliverables. At the end of the day, what are we going to give management with at the end of our audit? Upon completion of the audit, we will provide the audited financial statements for December 31st, 2024. That's going to be our year-end date. Beautiful. Put that there. All right, an independent auditor's report detailing our opinion. Yes, we're going to issue an opinion, whether that's qualified or unqualified. Typically, it's going to be unqualified because most of the time you're not going to have a qualified opinion, even though you can, obviously, if you have qualifications. And the easiest way to remember this is like, I remember I used to get so confused with this topic in college if it was unqualified or qualified. If it's unqualified, that means you have no qualifications to add. You're saying, hey, I agree that in all material aspects, this financial statement is free of material misstatement. That means you have no qualifications. But if you qualify your report, you're saying, hey, it's free of material misstatement except for these qualifications. I don't know, accounts receivable is off, inventory. Again, in practice, for the most part, most companies are not going to be okay with a qualified opinion, especially if they're bank covenants or if they're a publicly traded company. It's not going to look very good to investors or the bank or whoever that third party is, if there's certain errors in the financial statement. But again, can it happen? Yes. But for the most part, like for example, in my long career, I've never issued like an adverse opinion or anything like that ever. Have I issued a qualified opinion? Yes, I have. I've issued an opinion with certain qualifications that weren't damning at all. But again, I've issued some qualifications, yes, in my lengthy career. A management letter highlighting any deficiencies in internal controls and recommendations. Yes, we usually issue a management letter at the end of our audit with our findings and kind of a summarizing everything that happened during the audit and any additional reports required by law or regulation. This is a private company. It's CPA swag. They sell t-shirts. I highly doubt they're going to need anything else for law or regulation. Last, one of the most important things here, fees and billing terms. Again, our audit fees are estimated at, typically, I mean, if you're in practice, you typically don't want to be estimated. The client wants to know how much they're going to pay. I don't know. I'm just going to say for CPA swag, these guys are going to pay us $50,000 for the audit. Fine. That's how much we budgeted. They're a small startup company, whatever. 50 grand for the audit, even though I think that's super cheap, but $50,000 for the audit. Based on the assumption that the company, remember, that's CPA swag, will provide all necessary information in a timely manner. Additional charges may apply if unforeseen complexities arise or if significant additional work is required. Yeah, of course, this happens a lot, more often than not, because you have an initial plan, right? You build a budget based on their financials or the financials that the client provided you when you're going through your estimation and client acceptance process, which essentially we're doing right now. And we estimated, hey, based on the amount of work we're going to need to do, $50,000. But let's say, for example, we received their financials and management, I don't know, we quoted the job and they didn't tell us that, hey, by the way, we had a bolt-on acquisition on December 1st, 2024 that we just kind of forgot to tell you about. We have a whole other acquisition to do, a whole other company we're going to need to audit. We're going to need to do opening balance sheet procedures, fair value, everything. I mean, there's so much work that's going to have to do. So that $50,000 may not be as accurate because obviously there's certain things that we were not made aware of. So yes, that would cause here unforeseen complexities in significant additional work. Yeah. So you'd have to, the partner, the senior manager, the manager would have to talk to the client and say, hey, look, man, we built this job at $50,000 with the assumption that there was no other things that happened. Now that you're telling me you bought this other business, it's going to be much more. So then obviously that $50,000, again, that's going to be something above the level of an associate or a senior even. It's going to be someone a little bit more senior on the audit team that would handle that conversation. So nothing to worry about on that end. And then invoices will be submitted. This is also, again, this is something that's determined at the beginning of engagement. You can say invoices will be submitted at the end of each month during field work. During audit field work, and are payable within 30 days. Let's just say 30 days. That's fine. Nothing wrong with that. I want to get paid for our services as soon as we can, and we'll be submitting the invoices at the end of each month during, our audit field work or something like that. Or you can put it on a payment schedule, or you could put it, hey, the audit's going to be from February through March, so I'm going to invoice you at the end of every week during February or something like that. Well, you know what? Invoices will be submitted at the end of each week during audit field work or something like that. Again, you get my jazz. I mean, it's going to be something, a timeline that you and the client can agree on. Okay, and then we're going to get now into the agreement and signature section. So this letter represents the entire agreement between audit firm name. We're going to put BC CPA, that's me, and client name. We're going to put in here, we're going to put CPA swag, LLC. Again, it's not wrong to do this. We're just going to name the company in here. Any modifications must be agreed upon in writing. If you agree to the terms of this engagement, please sign below and return a copy to us sincerely. Then the audit partner would sign here, the firm name would sign here, and then that means I agreed and accepted. And then obviously whoever the client representative is, typically the client representative that's going to sign it is going to be the CEO or the CFO. He would sign date that he agrees to everything in this engagement letter. And once that's wrapped up, we should be ready to start our audit. So to wrap it up, initial communication sets expectations. Independence checks protect the integrity of the audit. And the engagement letter is your contract to ensure the audit runs smoothly. If you have any questions about the planning process, or if you come across any issues during your own audit planning process, drop them in the comments below. And if you found this helpful, don't forget to like this video, subscribe to the channel, and hit that bell icon so you never miss another video from me. Thanks for watching. I'll see you in the next one.